Welcome back. Today, we're going to walk straight into the data without noise, without hype, and without comfort language because what's unfolding in the silver market right now is not a normal cycle move, not a routine volatility spike, and not just another commodity story. This is a structural shift signal, and if you don't slow down and examine the mechanics behind it, you will miss what the numbers are trying to say. The latest policy change out of the Shanghai Futures Exchange is not rumor, not interpretation, not speculation, but a formal rule adjustment stating that beginning on the last day of February, participants without verified hedging quotas receive zero lot delivery allocation across all silver contracts. Zero, not reduced, not limited, not scaled, but zero. That is not a cosmetic tweak. That is an exchange-level defensive mechanism, and exchanges only move to defensive allocation rules. When delivery pressure and inventory stress reach levels they cannot ignore anymore, exchanges are designed to maintain confidence and smooth settlement. So when they tighten delivery eligibility, it is not because everything is abundant, it is because optionality is shrinking, and they need to control who gets access to physical settlement. First priority goes to industrial hedgers, not speculative participants. That single rule change tells you more about physical tightness than a month of headlines ever could, and you don't have to trust commentary. You can verify exchange circulars yourself because primary documents always matter more than influencer narratives. At the same time, price divergence between Eastern and Western markets continues to print numbers that should not exist in a perfectly arbitraged global commodity market. Western silver spot and futures pricing continues trading meaningfully below Shanghai pricing, creating a sustained premium gap. And when the same metal carries different prices depending on geography, that is not just currency conversion noise, that is a delivery preference signal. It means buyers in one region are willing to pay more for accessible metal than paper exposure priced elsewhere. And persistent regional premiums are one of the earliest indicators that physical supply chains are tightening. Relative to demand pools, arbitrage normally closes these gaps quickly unless friction exists, and friction only exists when movement of metal is slower, harder, or more expensive than movement of contracts. Paper moves instantly, trucks and vaults do not. Over the last several sessions, volatility has not behaved like a calm accumulation phase. It has behaved like a stress response, rapid percentage swings, fast recoveries, sharp intraday repricing, and heavy turnover. That kind of behavior often appears when positioning is crowded and liquidity providers widen risk tolerance bands rather than compress them. And while many observers celebrate fast rebounds, they often fail to ask the deeper question: rebounds from what and why? So fast, violent snapbacks often signal forced unwinds or delivery-related repositioning, not just renewed optimism. And when you combine that with exchange-level delivery restriction policy changes, the pattern deserves deeper inspection rather than emotional reaction. Meanwhile, vault flow data shows continued metal movement out of Western registered categories, and regardless of what interpretation you prefer, drawdown is drawdown. Inventories either rise or fall, and when they fall during rising price volatility, the burden of proof shifts toward tightness, not abundance. Open interest levels compared against registered inventory continue to show multiple paper claims per ounce of readily deliverable metal. And while that structure has existed for years and does not automatically trigger default risk, it does amplify sensitivity to delivery preference changes because only a small percentage of contract holders need to stand for delivery distress. The registered pool derivative systems function smoothly when most participants cash settle or roll forward, but when delivery appetite increases, the math tightens quickly, and that is not conspiracy language, that is contract structure arithmetic. Account suspensions and trading violation enforcement actions have also increased across certain exchange participants, and while compliance enforcement is not itself proof of shortage, clusters of suspensions during volatile delivery, sensitive periods, are rarely random. Exchanges intervene more aggressively when they detect behavior that could destabilize settlement confidence, and settlement confidence is the backbone of futures pricing mechanisms. Remove confidence and the derivative loses its anchor. So enforcement spikes are another contextual signal worth logging, not exaggerating but not ignoring either. Mainstream financial coverage has begun quietly inserting language about silver supply constraints into broader precious metals demand stories, and notice the placement. These comments rarely appear in headlines. They appear mid-article, mid-segment, mid-discussion, because editorial framing still prefers calm narratives. But wording matters when large outlets acknowledge supply strain even cautiously. It means the topic has passed internal credibility thresholds inside research desks. Journalists do not introduce constraint language without sourcing, because reputational risk is high, so when constraint language appears, it reflects at least some validated data streams behind the scenes. Industrial demand remains structurally different from monetary demand because it is consumption-based, not hoarding-based. Silver used in electronics, photovoltaics, electrification, infrastructure, advanced computing hardware, medical systems, and defense applications does not return to market in the same form at the same speed. Recycling exists, but recovery efficiency is limited and lagged, which means rising industrial intensity creates ongoing draw pressure, independent of investor sentiment. And when industrial draw intersects with investor accumulation phases, the two demand channels reinforce each other rather than offset each other. That is one reason silver historically shows sharper percentage moves than gold during tight phases, because its demand stack is more heterogeneous and less purely monetary. None of this guarantees immediate vertical price continuation. Markets do not move in straight lines, and timing remains the hardest variable, but structure tells you about pressure, and pressure tells you about potential energy, and potential energy matters more than daily candles when evaluating regime shifts. Short-term bearish cases still exist. Lease rate volatility can fall back. Contract rolls can relieve delivery month stress. Speculative positioning can unwind, and coordinated short pressure can suppress rallies longer than most expect. History proves that interventions and concentrated positioning can influence precious metals. Pricing for extended periods, fines, settlements, and enforcement cases over past decades confirm manipulation has occurred, and persistence of behavior shows that legal penalties alone do not eliminate strategic trading tactics. So intellectual honesty requires acknowledging delay scenarios alongside breakout scenarios. However, every delay mechanism depends on one core assumption that paper settlement preference dominates physical settlement preference. If that assumption weakens, even modestly leveraged dynamics change because synthetic supply cannot substitute for physical delivery when delivery is demanded, and exchanges respond to delivery demand signals through rule changes, margin adjustments, and allocation controls, which is exactly why policy updates deserve more attention than price commentary. Rules change before narratives change, and settlement mechanics change before headlines admit stress. Smart observers watch rulebooks, not thumbnails. Macro backdrop adds another layer: sovereign debt trajectories, monetary base expansion, geopolitical fragmentation, supply chain regionalization, and strategic resource nationalism all increase the strategic value of hard assets that cannot be digitally expanded. Metals sit inside that category, not because of tradition, but because of physical constraint, and physical constraint becomes more important when trust in policy discipline declines, currency strength debates, aside diversification behavior rises during uncertainty, and precious metals historically benefit from diversification flows, especially when real yields compress or volatility expectations rise across equity and credit markets. Conflicting institutional signals also appear at turning points. Some banks publish bubble risk alerts while others raise long-term metal targets at the same time. That divergence is not hypocrisy. It reflects model sensitivity. Differences, time horizon differences, and mandate differences. One desk measures momentum froth, another measures macro hedge necessity. Both can be internally consistent while externally contradictory. And when you see simultaneous bubble warnings and higher long-range targets, it often means the asset sits in a volatile transition zone rather than a simple trend phase. Transition zones are uncomfortable, but informative. The most important discipline right now is verification over amplification, primary sources over reposts, exchange documents over commentary, vault reports over screenshots, methodology over memes. If a claim cannot be traced to an official release, a regulatory filing, a transparent dataset, or a reproducible calculation, it belongs in the speculation bucket, not the decision bucket. Emotional certainty is not evidence, and viral repetition is not validation. Disciplined verification is slower, but it compounds accuracy, and accuracy compounds survival in financial markets. Survival matters more than excitement always.